Something unusual is happening in the silver market, and most people are only looking at the price, not the message behind it. Over the last several weeks, silver didn't just rise quietly. It surged, fast. From levels many thought were already expensive, silver accelerated into the low to mid-$90 range, briefly touching the mid-90s before pausing. And when a market moves that quickly, especially one as thin as silver, it's never random. There is always a reason, and there is always a risk hiding beneath the excitement. The real question isn't whether silver is bullish. The real question is whether this move is healthy, or whether the market is warning us that something important is about to change. If you've been watching markets for any length of time, you already know this feels different. This isn't the slow, grinding climb we see in typical bull markets. This wasn't silver quietly trending higher over years. What we just witnessed was acceleration. Price moved faster than most investors could react, and when that happens, emotions usually follow. Excitement on the way up, anxiety near the top, and confusion when price suddenly stalls. That pause you're seeing right now is not meaningless. In fact, it may be the most important part of the entire move. Before we go any further, if you follow markets closely and want calm, clear explanations without hyper-panic, make sure you like this video and subscribe to Calmly History. It really helps the channel grow, and it ensures you don't miss the next update, especially in markets like this, where timing and understanding matter more than headlines. Now let's talk about the number everyone is staring at: $100. In markets, round numbers carry weight far beyond math. They are psychological landmarks. Traders talk about them. Media amplifies them. Investors anchor expectations around them. And silver reaching toward $100 is not just a price event, it's a stress test. Historically, markets often hesitate before major round numbers, not after. That hesitation is where emotions peak, leverage builds, and mistakes are made. This is where smart money slows down and impatient money rushes in. To understand why this rally feels so intense, you need to understand the difference between a gradual bull market and a parabolic move. In a gradual bull market, prices rise in waves. Pullbacks are normal. Time allows investors to adjust positions. Parabolic moves are different. They compress years of movement into weeks or months. That compression creates fragility. The faster a market rises, the more sensitive it becomes to even small changes in sentiment. Silver didn't walk into the $90 zone. It sprinted. And when something sprints uphill, it eventually needs to breathe. Silver is also structurally different from gold, and this matters more now than ever. Silver is a much smaller market. It trades with lower liquidity, which means fewer buyers and sellers can move price much more aggressively. It also carries higher leverage in futures markets, amplifying both gains and losses. Gold can absorb large flows with less volatility. Silver cannot. That's why silver rallies feel explosive, and silver pullbacks feel sudden. It's not manipulation. It's structure. And understanding that structure keeps you from being surprised when volatility appears. Another critical point most people are missing is this. This move was not driven by retail excitement. This was not social media hype or a sudden wave of small buyers. The drivers behind silver's rise were macroeconomic, geopolitical tension, currency stress, bond market instability, trade policy uncertainty. When those forces appear together, silver reacts quickly because it sits at the intersection of precious metal safety and industrial demand. That combination makes silver extremely sensitive to global stress. In other words, silver didn't move because people wanted it to. It moved because the system pressured it to. And here's where the real insight comes in. When a market reaches toward a major psychological level like $100, the risk is not that it collapses instantly. The risk is that people assume it can only go one direction. Markets don't work that way. They test confidence. They shake weak hands. They pause when expectations become too one-sided. That pause doesn't mean the trend is over, but it does mean the easy part of the move may already be behind us. So as silver hovers and struggles to push cleanly higher, the most important thing to remember is this. Markets usually pause before major milestones, not after. That pause is information. And in the next segment, we're going to break down what actually pushed silver this high in the first place. Because once you understand the drivers, you'll see why this rally was powerful and why it may not move in a straight line from here. To really understand why silver moved this fast, you have to stop looking at silver itself and start looking at what broke elsewhere first. Markets rarely react in isolation. Silver didn't suddenly decide to surge on its own. It responded to pressure building across the global financial system, pressure that had been quietly increasing long before most people noticed the price on their screen. When silver moves like this, it's usually because something else has already gone wrong. One of the earliest triggers came from rising geopolitical tension tied to Greenland. Tariff threats connected to strategic resources may sound distant, but markets don't wait for conflict to happen. They price risk early. As trade uncertainty returned, investors started reassessing supply chains, critical materials, and the reliability of global cooperation. Silver sits right in the middle of that conversation because it is both a precious metal and an industrial input. When trade policy becomes uncertain, silver doesn't get ignored. It gets pulled into focus. At the same time, something far more technical, but equally important, was happening in Japan. Japanese government bonds, long considered one of the most stable corners of the global debt market, saw a sharp sell-off. That matters more than it sounds. When confidence cracks in sovereign debt, even slightly, it sends ripples through global markets. Investors start asking uncomfortable questions about fiscal discipline, debt sustainability, and how long central banks can keep things under control. That bond sell-off didn't stay in Japan. It spilled into global sentiment. As bond stress increased, the US dollar weakened. And this is where silver really started reacting. Precious metals are highly sensitive to currency moves, especially when the dollar loses strength during periods of uncertainty. A weaker dollar doesn't just make silver cheaper for foreign buyers. It also signals that investors are quietly hedging against policy risk and monetary instability. Silver tends to move hard when currency confidence starts slipping, even if headlines aren't screaming about it yet. Another factor many people missed was growing concern around sovereign debt discipline more broadly. Governments around the world are running massive deficits, and markets are becoming less forgiving. When bond yields move unexpectedly and central banks are forced into difficult choices, silver reacts as a hedge against policy mistakes. This isn't fear-driven buying. It's positioning. Institutional players don't wait for confirmation. They move when risk-reward shifts, and silver was one of the first markets to reflect that shift. Now let us talk about something that doesn't show up on most price charts, but matters deeply to silver: the physical market. During this rally, physical silver was being pulled from Europe into U.S. vaults. That flow tightened availability in wholesale markets. When metal moves across regions, it creates temporary imbalances. And silver is particularly sensitive to that because supply chains are already stretched. Tight wholesale availability doesn't mean shelves are empty, but it does mean large buyers are competing for fewer bars at the same time. This is where the story gets interesting. While retail investors were watching price, institutions were watching access. When access tightens, price follows. This wasn't driven by social media excitement or a sudden rush of small buyers. This was macro positioning by larger players responding to currency stress, trade uncertainty, and physical flow disruptions. That's why the move felt so sudden. When institutions act together, silver doesn't drift higher. It jumps. And here's the key insight that calmly history always tries to highlight. Silver doesn't lead crises. Silver reacts to them. Stress shows up first in bonds, currencies, and geopolitics. Silver follows when those pressures reach a tipping point. That's exactly what happened here. By the time silver surged into the 90s, the warning signs had already been flashing elsewhere for weeks. But when markets move this fast, they rarely move in straight lines. The same forces that pushed silver higher can also create sharp pauses when conditions shift even slightly. That doesn't invalidate the move, but it changes the risk profile. And in the next segment, we're going to look at what happened when some of that pressure eased, why silver suddenly slipped back, and why that pullback may be the warning most people are ignoring right now. After silver raced toward the mid-90s, something important happened. It stopped. The market tried to hold near those highs, but it couldn't stay there. Prices slipped back below the $93 area, and for many viewers, that sudden pause felt confusing. After such a powerful rally, people expect follow-through. But markets don't reward expectations. They respond to changing conditions, and those conditions shifted faster than most realized. The first change came from easing geopolitical tension. When uncertainty is high, investors rush toward protection. When uncertainty cools, even slightly, that urgency fades. Statements signaling that military force was not on the table reduced immediate fear in global markets. That doesn't mean long-term risks disappeared, but it did mean the most aggressive defensive positioning was no longer necessary in the short term. Silver, which had benefited from that fear, reacted accordingly. At the same time, broader risk assets began to stabilize. Equity markets found footing. Volatility cooled. U.S. Treasuries, which had been under pressure, stopped sliding and started attracting buyers again. When bond markets calm down, it sends a powerful signal. It tells investors that panic is not spreading, at least not yet. And when that signal appears, metals like silver often pause because some of the urgency behind the move has been removed. This is where many people misunderstand what they're seeing. A pullback after a parabolic move is not a failure. It is a test. When prices rise too fast, markets need to check whether buyers are still willing to step in at higher levels. That process often looks messy. Sudden dips, sharp reversals, emotional reactions. But this behavior is normal, especially in a market as thin and leveraged as silver. Profit-taking also plays a major role here. Many investors entered silver far lower, long before prices approached these levels. For them, locking in gains near historic highs is not fear, it's discipline. When enough participants decide to take profits at the same time, price naturally pulls back. That doesn't mean they've turned bearish. It simply means they are managing risk after an unusually fast move. Another factor amplifying the pullback is leverage in the futures market. Silver futures are heavily traded with borrowed money. When price moves sharply, margin requirements change, stop-loss orders trigger, and forced selling can occur, even if fundamentals remain intact. This creates a feedback loop. Price dips trigger selling, selling pushes price lower, and that movement looks scarier than it actually is. This is why silver pullbacks often feel sudden and dramatic. What's important to understand, and what calmly history always tries to communicate clearly, is the difference between a collapse and a warning. A collapse is driven by broken fundamentals. A warning is driven by momentum slowing. What we are seeing here is a momentum warning. The market is telling participants that the easy part of the move may be over, and that future gains will require stronger conviction and better conditions. This pause also serves another purpose. It shakes out weak hands. Investors who chase the move late often exit at the first sign of discomfort. Meanwhile, longer-term participants watch closely to see whether support holds and whether underlying drivers remain in place. That battle between short-term emotion and longer-term structure is exactly what creates volatility near major price levels. So when silver slipped below the $93 mark, it wasn't a signal that the story had ended. It was a signal that the market was reassessing. It was asking whether the forces that pushed price higher were still active, or whether conditions had changed enough to justify caution. That reassessment phase is uncomfortable, but it is also informative. And here's the part most people miss. Markets rarely issue warnings with sirens. They whisper first. They slow down. They hesitate. They test patience. This pullback was not loud, but it was meaningful. In the next segment, we're going to talk about the level everyone is watching, why round numbers like $100 create extreme volatility, and why what happens near that level matters more than the number itself. When silver approaches a number like $100, the market changes its behavior, not because the fundamentals suddenly shift, but because human psychology takes over. Round numbers have a strange power in financial markets. They attract attention from the media, they dominate headlines, and they pull in traders who may not have been watching before. At the same time, they quietly trigger decisions from investors who have been holding for a long time and are now sitting on very large gains. For many participants, silver near $100 represents a milestone. Some bought silver years ago at much lower prices. For them, reaching this level means doubling their money or more. That creates a natural incentive to take profits, not out of fear, but out of discipline. When enough people think the same way at the same price, volatility increases. Price doesn't glide through levels like this. It hesitates, it overshoots, and it snaps back. This effect is even stronger in thin markets like silver. Unlike larger markets that can absorb huge volumes without dramatic price changes, silver reacts sharply when buying or selling pressure appears. Fewer participants means each decision carries more weight. That's why silver often struggles to move cleanly through major milestones. It's not because the trend is broken. It's because the market is negotiating a psychological barrier. Another thing that adds confusion at these levels is the difference between spot price excitement and physical market confirmation. Spot prices can jump quickly on screens, driven by futures trading and short-term positioning. Physical markets move more slowly. They depend on logistics, delivery, and actual metal changing hands. When spot prices race ahead of physical confirmation, markets often pause to see whether the move is justified. That pause can look like weakness, even when the broader structure remains intact. This is where many investors get caught off guard. They see headlines celebrating new highs and assume momentum will continue without interruption. But markets don't move to reward headlines. They move to test conviction. Near $100, silver is doing exactly that. It is asking participants how committed they really are. Are they holding because they understand the forces behind the move, or because they don't want to miss out? Several scenarios can unfold near a level like this. One possibility is sharp swings in both directions, as buyers and sellers fight for control. Another is a false breakout, where price briefly moves above the level, only to retreat as profit-taking accelerates. Temporary reversals are also common, where the market pulls back, consolidates, and forces participants to reassess their assumptions. None of these outcomes automatically mean the bull market is over. They mean the market is working through a decision. What calmly history tries to emphasize is that conviction matters most at moments like this. Easy trends feel comfortable. Difficult levels reveal who has a plan and who is reacting emotionally. $100 is not an ending point for silver, but it is a testing ground. It separates long-term positioning from short-term speculation. It exposes leverage. And it reminds everyone that volatility is the price of participation in this market. It's also important to remember that volatility itself is not a signal of failure. In silver, volatility is normal, especially near historic price levels. Sharp moves don't always reflect changing fundamentals. Often they reflect crowded positioning and emotional decision-making. Understanding that difference helps investors avoid mistaking noise for direction. As silver moves around this level, the most important thing is not the exact price, but how the market behaves. Does buying return after pullbacks? Does physical demand remain steady? Do broader macro conditions continue to support precious metals? Those answers matter far more than whether silver briefly touches or retreats from a round number. So when you hear excitement or fear tied to $100, take a step back. This level doesn't end the story, but it does challenge it. And in the next segment, we're going to look at the deeper foundation still supporting silver, because beneath all this volatility, there are structural forces that haven't gone away. After everything we've talked about, this is the part most people overlook, especially when prices get noisy. Short-term pullbacks grab attention, but long-term structure is what quietly controls where silver goes next. And despite recent volatility, the foundation under silver has not disappeared. In fact, many of the forces supporting this market are still firmly in place, even if they aren't making headlines every day. Before we continue, if you value calm, clear explanations instead of emotional market noise, take a second to like this video, subscribe to Calmly History, and share it with someone who follows metals or macro markets. Also, let me know in the comments how you're viewing silver right now. Your support helps this channel reach more people who want understanding, not hype. One of the strongest supports under silver is something that rarely gets enough attention: supply. The global silver market is facing its fourth consecutive year of supply deficits. That means demand has consistently outpaced new supply. Mine production has struggled to grow fast enough, not because companies don't want to produce more, but because mining is capital intensive, slow to expand, and increasingly constrained by costs and regulation. New supply doesn't appear just because prices rise. It takes years, not months. At the same time, industrial demand for silver remains structurally strong. Silver isn't just a store of value. It's a critical input in electronics, energy technologies, and manufacturing. That demand doesn't disappear when markets pull back. It continues quietly in the background, creating a steady draw on available supply. This is one of the reasons silver behaves differently from purely financial assets. It has a real-world function that keeps demand anchored even during corrections. Some people point to easing lease rates as a sign that shortages are fading. But easing lease rates do not mean surplus. They simply suggest that immediate stress has relaxed slightly. Physical tightness can still exist even when short-term pressure eases. Think of it as congestion easing on a highway, not the road suddenly becoming empty. Metal is still moving, still being absorbed, and still facing limits on how quickly new supply can respond. What really matters going forward is not whether silver moves up or down in the next few days, but what's happening beneath the surface. Investors should pay attention to currency stress, especially signs of renewed weakness or instability. Precious metals tend to react quickly when confidence in fiat currencies begins to slip. Bond market behavior also matters. Sudden moves in yields or loss of confidence in sovereign debt often spill into metals, sometimes before headlines catch up. Trade policy is another key factor. Shifts in tariffs, restrictions, or geopolitical alignments can affect both demand and supply chains. Silver sits at the crossroads of these issues. And finally, physical premiums tell an important story. When premiums rise or stay elevated, it suggests real-world demand is stronger than what paper prices alone may indicate. This is why volatility in silver should not automatically be viewed as a problem. Volatility is part of silver's nature. It reflects its smaller market size, its leverage, and its dual role as both a precious and industrial metal. Sharp moves can feel uncomfortable, but they don't automatically signal weakness. Often, they signal adjustment. What Calmly History wants viewers to take away is simple. Silver doesn't move in straight lines, and it never has. Pullbacks don't erase structure, and rallies don't remove risk. Understanding both sides is what keeps investors grounded when emotions run high. So as silver continues to move, remember this: volatility is not a flaw in the silver market. It's a feature. It's the cost of exposure to a metal that reacts quickly to stress, uncertainty, and change. If this video helped you see the bigger picture, make sure you like it, share it with someone who follows markets, and subscribe to Calmly History for more calm, fact-based discussions like this. And drop a comment below with your thoughts, because the conversation doesn't end here.